Welcome back. It's Rob again with Perfect Spiral Capital. Today we're picking back up in our myths about the infinite banking concept series. If you want to call it a series, there's only 2 videos, but this is the second of those. And we're going to talk about some of the different myths that exist around the infinite banking concept and some of the common objections that people may have brought forward. In our last video, we walked through a couple of those. This one, we're going to talk more specific about some that come from some of the financial personalities that exist, whether that's on YouTube or online, radio shows, what have you, and talk more through some of those myths specifically. Some of these individuals have pretty strong opinions on the product or on the process itself, and we're going to talk through those. We're going to debunk those and understand some of the things behind it that help us see why some of these myths are not really what they are made out to be. The first one here is that the agents get paid high commissions, or the reason that it's done or the reason that the product is selected is simply because the agent gets high commissions. Well, there's a lot of different ways that we can attack or look at this one. Before I dive into this one, I actually want to ask a couple of questions. And the first question is this: when you buy a product for the long term that has a high level of service expectation with it, and you are expecting to be able to use that product, use that service in the long run, do you want that company to be profitable so that it can continue to deliver for you well into the future based off of those servicing expectations or the expectations you have of that product? Do you expect them to honor the warranties that come with a given product well into the future? Those are things to think about first and foremost, especially when you want to be able to use or have the company make good on those. Secondly, when you make a purchase virtually anywhere, are you thinking about how much that person personally made in that particular interaction or that sale? Again, these are just legitimate questions to ask because I think it's important to call out our mindset when we're going into any one of these types of scenarios. The third question I have: when you put your money into your 401k, do you consider or do you go ask the company or the person who runs the benefit side of your company, do you go ask them what that agent who set up the 401k contract for that company is making in commission every time you make a contribution to your 401k, every time that there's a change made within your 401k, and who's making the commission on all those fees that are charged within your 401k? Are you also doing that? Maybe in a different manner, what about when you purchase a car? Are you thinking, or are you wanting or demanding to know how much the person who is selling you the car is making on that car? I don't know. I mean, these are just general questions to be asking. The reason these are important is you have to be thinking a little bit different about these situations instead of letting someone else do the thinking for you. The thing I like to think about is if I'm purchasing a product from someone and there's long-term expectations for servicing, long-term expectations for service of the product, whatever it might be, I want to make sure that that person's there. I want to know that that company's still going to be there. So I want that company, I want that person to be profitable so that they are able to fulfill on all those needs that I have for a given product. So we should maybe be thinking differently about these terms a little bit differently than somebody simply saying, oh, well, they only do it for the commission. Well, we all have to make money. We all make money in different ways. And as someone who is in the infinite banking space, and I do get paid off of some commissions, I look at commissions as a short-term solution for a long-term plan that I have for my clients. I generally am getting paid once and expecting to service my client for the rest of my lifetime. So that's a big commitment that I'm making on my end. And sure, I want to be paid appropriately for that, but I'm not going to go out of my way to try to do something just to earn a larger commission. That's not doing what's in the best interest of my client, or nor is it for anybody else to do so. But simply putting out an argument and saying that a product is bad just because someone makes a commission is absolutely ridiculous. People make commissions on things all the time and in all kinds of other disciplines. So if you're only going to focus on the commission in a given product area but not do it everywhere else, why are you being so inconsistent? If you're going to make that a big focal point, you should be making that a focal point in all purchases that you make. So just challenging you there to think differently. So myth number 2 in this section is you lose the cash value when a person passes away within the contract. This one to me is really just silly because it either shows a level of ignorance or it shows a complete level of misunderstanding about how these permanent or whole life products actually work in terms of the cash value. The cash value in a contract is the net present value of the death benefit itself. So it's the current equity that's available to you as the contract owner. The company itself is still obligated to pay the entire full death benefit. That is what they're going to pay in this particular situation. And that is the intent behind the entire contract. So they don't actually keep, quote unquote, the cash value. It's that the cash value is simply the equity available to you at that particular point in time. They're still on the hook for the entire death benefit of whatever that may or may not be at a given point in time. So the only time that cash value is going to equal or be really close to the death benefit would be at age 121. In the event that somebody did not pass away, the contract would endow at that particular point in time to the owner in that situation. Let's say, for example, that a individual has a whole life contract. It's currently valued. The death benefit amount listed at the time is $1.5 million. Let's say that there's $650,000 of available cash value built up in the contract that's presently available to the contract owner. And then let's say that this person has paid in up to this point premiums equaling or totaling $350,000. The $650,000 of cash value is going to be a combination of the death benefit that's been paid for through the base premium, through the paid up additions premium, as well as the dividends and the actual cash value growth that's guaranteed within the contract. If this person passed away, even though there's $650,000 of available cash value, the beneficiary of this person who's insured would receive the full $1.5 million. The $650,000 is simply the equity available at that present time, the net present value of the death benefit that was available to the insured. So when the beneficiary receives the $1.5 million that's currently available as death benefit in this contract, they're simply making due on their contractual obligations and doing what they're supposed to. In some respects, when people say that the insurance company keeps the cash value, in this case, even though you've maybe put in $350,000 into this contract, they're actually going to give you $1.5 million. In this particular situation, somebody would have paid $350,000, and in turn, they received $1.5 million. Well, if you subtract those two numbers, in effect, somebody is receiving $1.15 million. The reality remains no one's keeping cash value. It's simply they're paying out the death benefit for what's been paid in up to this point. The only time there would be anything removed from that would be if there was an outstanding policy loan, for example, then that would be removed from the total death benefit. Our next myth here is one in which some people say that it's a terrible place to put money. Let's really think about that for a second. That's coming from a product versus a process-focused understanding, and it's not thinking about the process of banking. I would ask the question of, from what perspective is it a terrible place to put money? In comparison to what? By that logic, is putting money into someone else's bank also a terrible place to put money? Legitimate question, right? If someone's not using this process, if someone's putting money someplace else, how is that helping them to solve for the banking function that exists in their life, or that banking problem that we all have, whether we realize that or not? How does that help you recoup the interest that would have been lost to third parties through interest costs, or even through the lost interest that could have been earned when somebody's paying with cash? How does it solve for that? As I've highlighted already, there's a lot of guarantees that exist within a whole life insurance contract with a mutual dividend paying company. That includes the guarantees of growth within the contract itself. It includes the guaranteed access to capital, the guaranteed death benefit. There's lots of these things that exist there. Thinking back to the last example that I just used in the previous myth, where someone had paid in $350,000 into a whole life contract, and the death benefit of that contract is $1.5 million, but they also currently have access to $650,000 in cash value. Well, that doesn't really match up when you consider that they have $350,000 into the contract, but yet they can access $650,000. And I will say this is a pretty realistic example from some of the cases and situations I've worked on before. And in some respects, this may even be on the conservative side, depending upon someone's particular situation. When we think about it from that angle, having $650,000 of cash value access to take care of the banking function within our lives isn't necessarily a bad thing. And it's helping to solve for a problem. Whereas simply thinking about it from a product-based perspective and thinking that I can get a higher rate of return on something, that doesn't solve the banking function. That's simply, this is a bigger number than this one, so that means this must be a better product. And it's excluding all the other aspects of the problems that this process is really designed to help solve for. So if somebody's not thinking about the process and the function of banking, they're going to be thinking about it from a flawed perspective or a flawed viewpoint versus the way we're looking at it in this particular situation. The question in this case that needs to come up when this myth or question is posed is, number one, in comparison to what, and how does that help me solve for the function of banking in my life? That takes me to our final item in this section, and that is that it's a terrible investment. Well, I have news for you. First and foremost, it's not an investment. Secondly, the infinite banking concept is a process, not a product, as we've highlighted multiple times here. And I'll just reiterate again, life insurance is not an investment. So comparing it to an investment is a flawed perspective right from the beginning. Solving for the banking function, creating a strong foundational platform for our money, along with a substantial reduction in overall risk within our lives, is a great foundational place of strength to then be able to go to invest. So this is a point where one of my colleagues mentioned recently, his name is Joe, he had called out that this is really a before asset, meaning that it's all about creating foundation and creating structure in which we create an environment that becomes conducive to investing. That's really what being able to reclaim the banking function, first and foremost, helps us create a strong platform. And then from there, we can think about how we would want to invest. And then it also gives us the ability to control where and how we invest and get more out of the situation than what we maybe normally would have. As I've highlighted before, this really is an and asset. It's not an either or approach. It's a situation where we can implement the process and then be able to go invest with more confidence and go put our money to use, perhaps in more income producing type assets, where the investment part of it is more under our own control, perhaps. Investing in ourselves is probably the number one place to be able to get the highest level of return, if you want to look at it in those terms, more than anything else. If I can go start a business that maybe I wouldn't have been able to do otherwise, and that business grows exponentially, and then I'm able to sell it at a later time, how do you put a rate of return on that? It's really difficult to do that, right? This process and this concept gives us some of these foundational aspects to be able to go out and do such things. And again, if someone is more prone to just investing in the market, guess what? You can still do that too. And that's really what it's all about. It's about creating foundation. It's about creating a basis from which we can build upon. So no, it's not an investment, and it shouldn't be looked as one. And it also shouldn't be compared as either or. I hope our discussion today has helped you to maybe see some of these myths and some of these comments a little bit differently than you would have otherwise. So I would just challenge you that you don't have to completely take my word for it. You can go find these things out. You can really dig into them a little bit more. I would encourage you to do that. You can also check out some of the educational aspects of our page at perfectspiralcapital.com. We have a lot of great resources there for you to dig in and take a look as well. That being said, I hope this video was valuable for you today. I hope you're able to learn something or maybe even change your perspective in thinking about some of these areas a little differently. If it was, please feel free to like and subscribe. Feel free to comment and interact with us. We'd love to hear from you. You can also reach out via the website through the informational notes that we have below, and we'll talk to you again soon. Have a wonderful day.